Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
February 5th, 2026. If you were watching the ticker KOS, you saw blood in the water. Cosmos Energy plunges 15.4% in a single trading session, hitting a low of $1.30. The volume was just absolute capitulation. 16.59 million shares dumping the stock. I mean, it looked like the end of the line. But then, barely 24 hours later, whiplash. February 6th, the stock rips back up, gaining almost 14% to close at 148.
But you have to look closer at that rebound. The volume on the way up, only 12.79 million shares. So the exit door was significantly more crowded than the entrance. And if you zoom out to the 52-week range, we are staring at a floor of 84 cents against a ceiling of $3.49. We are flirting dangerously with the bottom of the barrel here.
That volatility is the price of admission for what we're discussing today. The narrative for Cosmos Energy right now is a violent tug of war between two, mutually exclusive realities. On one side, you have a company that has fundamentally transformed its physical operations, bringing massive LNG assets online and hitting huge deep-water oil targets. On the other side, you have a credit market that is just screaming about insolvency.
It's the classic inflection or insolvency setup. The central question isn't about geology anymore, it's about survival. Is this a deep-water value play that's about to re-rate, or is it a distressed trap about to snap shut on equity holders?
I'm taking the position that the market is pricing in a bankruptcy that simply isn't going to happen. The panic selling is reacting to a rear-view mirror view of the balance sheet, while ignoring the operational pivot that has, already occurred. This is a fundamental misunderstanding of the asset base.
And I'm taking the view that operations don't matter if the bank takes the keys. The debt burden, the recent downgrade to CCC, and the tight covenants make this uninvestable for anyone who cares about capital preservation. You can have the best oil in the world, but if your capital structure is broken, the equity, well, it goes to zero.
Okay, so let's get into the specifics, because the broken company narrative really misses the transition. Cosmos is not the frontier explorer it used to be. For a decade, this was a high-risk wildcatter burning cash to find the next big field off the coast of Africa. That is not the company today. They are now a diversified producer. The headline the market is ignoring is the Greater Tortue Ahmeyim Yame Project, or GTA.
A project that's been delayed so many times it became a running joke in the industry.
Delays are sunk costs. We have to deal with the present. In December 2025, the floating LNG vessel, the Jimmy, hit nameplate capacity. That's 2.7 million tons per annum. That is real gas flowing now into a global market that is desperate for LNG. And it's not just gas. Look at Ghana. The Jubilee field is performing. The J74 well, which we just got data on, encountered 50 meters of net pay.
Let's just pause on net pay for a second, so we aren't just throwing jargon around.
Fair point. Net pay is the thickness of the rock that is actually capable of holding and producing oil. 50 meters is massive. It's like a skyscraper of oil-saturated rock. That single well is adding 10,000 barrels of oil per day. So we're looking at a company priced at 0.58 times its book value, literally trading for nearly half the value of its steel and reserves, right as the cash flow floodgates are opening.
I admire the enthusiasm for the geology, I really do. But you're looking at the rocks and I am looking at the balance sheet. The capital structure here is, frankly, terrifying. You mentioned price to book, which is a vanity metric in this sector. Let's talk about the ratio that determines survival. Debt to equity. It is sitting at 3.31x. That is suffocating.
It is high. I'm not claiming they have a fortress balance sheet.
That signals? In credit rating terms, CCC means currently vulnerable to non-payment. They explicitly warned of a debt restructuring that could be viewed as a distressed transaction. In plain English, that usually means equity gets wiped out or severely diluted to save the creditors. You see a rebound in the stock price, I see a dead cat bounce. When net debt is nearly $3 billion on a company with a market cap of $707 million, the equity is just a call option on the debt not defaulting.
That is the bear case in a nutshell, but I think you're overstating the immediacy of the threat. You're treating a liquidity squeeze like a solvency crisis. Let's tackle this debt wall head on, because that is the elephant in the room.
It is the only thing that matters right now. We have to talk about the debt service coverage ratio, the DSCR. This is the covenant that kills companies. S&P estimates a breach is possible as early as March 2026, or September at the latest. If they breach that ratio, the lenders can call the debt. Game over.
But they haven't breached it, and the management team isn't sitting on their hands waiting to die. They are making aggressive moves to ensure they don't.
They are maneuvering, sure. But look at the reserve-based lending facility, the RBL. This is their credit card, their lifeline. They managed to get a waiver on the leverage ratio, but look at the terms. It's razor thin. The waiver allows for 4.25x leverage for the March 2026 test. They are tracking right against that line.
But they are under the line. That is the definition of compliance.
Barely. The formula they use, net leverage equals total debt minus cash divided by adjusted EBITDA, is unforgiving. Think about the sensitivity here. Any slip in EBITDA, any drop in spot oil prices, or a hiccup at that GTA project you love, and the denominator shrinks, the ratio spikes, they default. You are betting on perfection in a very volatile industry.
I'm not betting on perfection. I'm betting on execution, which they've demonstrated. You're assuming a static situation, but management just pulled off a significant refinancing maneuver that the bears said was impossible. In January, they redeemed the 2026 notes. How? They secured a $250 million term loan from Shell.
Secured against their best assets in the Gulf of Mexico? They're mortgaging the furniture to pay the rent. That isn't a victory. It's desperation.
It's utilizing their asset base to bridge a liquidity gap. That's what assets are for. That Shell loan pushes the maturity out 4 years. And more importantly, they access the Nordic bond market. They raised $350 million.
At 11.25% interest, due 2031. Just stop and think about that rate. In a world where rates are stabilizing, paying 11.25% is the market screaming that you are a distressed borrower. That is deep junk bond territory.
It is expensive capital, absolutely. I'm not arguing that 11.25% is a bargain.
It's not just expensive, it's destructive. It destroys free cash flow generation. All that money from the LNG you're banking on, it's going straight out the door to pay interest on these bonds. You're working for the bondholders now, not the shareholders.
But it proves market access. The entire bear thesis 2 months ago was that the capital markets were closed to Cosmos. They can't refinance, they said. They're insolvent. This bond proves the markets are open. They can use that cash to handle the tender offer for the 2027 notes and pay down the RBL. It buys them the runway they need for the GTA cash flows to actually hit the bank account. You call it mortgaging the furniture, I call it buying time for the payload to arrive.
A bridge that costs double-digit interest is a very, very expensive bridge. It puts huge pressure on the asset performance. Let's assume they survive the March covenant test. You're banking everything on operational perfection.
I'm banking on the fact that the heavy lifting is done. Let's go back to Ghana. The J74 well success pushes the Jubilee field to nearly 70,000 barrels per day gross. That is a massive volume of oil. And they just secured license extensions through 2040. This isn't a short-term grab. They have amended the development plan to include up to 20 additional wells. That is long-term visibility.
Operationally, Ghana is solid. I will give you that. The geology there is world-class. But there is a poison pill in those contracts that people gloss over. The Ghana National Petroleum Corporation, GNPC. Starting in July 2036, their interest increases by 10%. That effectively dilutes Cosmos. You're losing a chunk of the pie.
2036 is a decade away. In the context of a company trading at $1.48 today, cash flows 10 years out are heavily discounted anyway. If you're buying KOS at $1.48, you're playing for the re-rating in the next 12 to 24 months. You are not buying it to hold for your grandchildren.
The value is also at risk in Mauritania and Senegal regarding GTA. You talk about GTA like it's a Cosmos project. It's operated by BP. Cosmos is a minority partner. They have no control over costs or schedules. We've seen what happens when partners disagree or when the operator runs over budget. Cosmos is a passenger in its own flagship vehicle.
Being a partner with BP is a strength, not a weakness here. It de-risks the technical execution. BP knows how to run complex LNG. And let's look at the liftings. That's the actual cargo being loaded. 18.5 cargoes lifted in 2025. They expect that to double in 2026. This is the revenue pillar I keep emphasizing. LNG contracts decouple them from the volatility of oil spot prices. When you have contracted LNG earnings, your EBITDA becomes much more predictable, which actually helps stabilize that leverage ratio you're so worried about.
It stabilizes it if everything works, but with a CCC rating, you have zero margin for error. If a compressor fails on the FLNG vessel, which happens all the time on these new floating facilities, or if there's a weather event, that EBITDA coverage evaporates. And because the covenants are so tight, a mechanical failure becomes a default event.
That's true for any E&P company, though. Operational risk is inherent, but let's compare them to their peers to see if the risk is priced in. Look at the valuations. Kosmos has a market cap of around $707 million. Compare that to APA Corp at $8.49 billion or Murphy Oil at $4.4 billion.
Those companies are not comparable. That's apples and hand grenades.
They are absolutely comparable in terms of sector and activity. They're all independent E&Ps with international exposure. But the valuation gap is massive. The analyst consensus price target for Kosmos is between $2 and $2.08. That's a 40% upside from current levels. Why? Because the market is pricing KOS like it's already dead. If they simply survive, the re-rating is automatic.
The valuation gap exists for a very good reason. Murphy Oil pays a dividend yield of around 4.4%. Kosmos pays 0. Murphy has leverage of 1.7x. Tullow is at 0.1x. Kosmos is at 3.31x. Investors are flocking to APA and Murphy because they want safety and yield. They don't want a binary lottery ticket.
But Kosmos is reinvesting, not paying dividends. That's the growth stage argument. They are putting money into the Gulf of Mexico, into short-cycle infrastructure-led exploration, ILX. The Tiberius project has a final investment decision expected in 2026. This is about future growth, whereas Murphy is about maintaining the status quo. You buy Murphy for rent, you buy Kosmos for appreciation.
Reinvesting is a luxury for companies that aren't drowning in debt. When you're fighting for liquidity, every dollar spent on exploration is a dollar not servicing debt. It's reckless. It's like buying new rims for a car that's about to be repossessed.
It's essential. If you stop drilling, you die a slow death because your reserves deplete. They're balancing the two. But let's talk about who is actually buying and selling this stock, because the sentiment data is fascinating.
It certainly is. If you want to know what management thinks, look at what they do, not what they say. On February 3rd and 4th, right as the stock was sliding, we saw significant insider selling.
I knew you'd bring that up. It's a favorite bear talking point.
Because it matters. CEO Andrew Inglis sold about 148,000 shares. CFO Neela Shah sold nearly 79,000 shares. They were selling in the $37 to $42 range. When the people running the company are hitting the sell button into a downtrend, that sends a terrible signal to the market. It screams abandoned ship.
That is a superficial reading of the filings. If you actually look at the Form 4s, those sales were primarily for tax withholdings related to RSU vestings. It happens every year at this time. In fact, if you look closely at the transaction, Andrew Inglis actually acquired 118,539 shares through vesting before selling the portion to cover taxes. He netted more shares. He didn't dump his position, he just paid his tax bill.
Fair. That is the technical explanation. But optics matter in a crisis. When the stock is tanking, seeing the CEO sell any shares rattles the cage. And it's not just insiders. Patient Capital Management sold over 16 million shares in January. That is a massive institutional exit. That's a fund saying, we are done with this story.
And Equinox Partners increased their holdings by 41.6% in mid-2025. Smart money is fighting over this. But you know who isn't there? Retail.
Zero retail presence.
Exactly. MarketBeat shows 19 searches in the last 30 days. 19. StockTwit sentiment is NA.
Which means nobody cares.
No, it means the price action is purely driven by institutional macro flows and credit fears. There's no meme stock premium here. It's a neglected stock. And for a contrarian, neglected usually means undervalued. The lack of retail noise allows for a pure valuation play.
Or it means irrelevant. The lack of retail interest means there's no army of small investors to prop up the price if the institutions decide to flush it. It leaves the stock vulnerable to these 15% drops we just saw. Liquidity dries up fast when the big boys leave.
It also leaves it open to 13% gains on a single day. The volatility cuts both ways.
Let's bring this to a close, because the clock is ticking on their debt covenants. My final word is this. The CCC rating is the truth. The market is demanding 11.25% on their debt because the risk of default is real. We have a company with a PE ratio that is not meaningful because they posted a $124 million net loss in Q3 2025. This is not an investment. It is a gamble on avoiding bankruptcy. If you buy equity here, you're basically buying a call option on a restructuring negotiation. And history tells us equity holders rarely win those negotiations.
I see it differently. The infrastructure is built. The heavy lifting is done. The wells are flowing, both at GTA and Jubilee. The Shell loan and the Nordic bond have bought them the time they need. If they survive the March and September covenant tests, which I believe they will, the stock doesn't just inch up, it re-rates massively toward that $2 target. You are buying a world-class asset base at a distressed price, just as the revenue is turning the corner. It's asymmetrical upside.
It is a binary outcome. There's no middle ground here.
We can agree on that. KOS is either a multi-bagger recovery play or a restructuring candidate.
And investors won't have to wait long to find out.
Precisely. The Q4 2025 results drop on March 2nd, 2026. Everyone needs to be watching the debt service coverage ratio in that report.
That number will decide the future of the company.
Until then, the debate continues.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.